Okay.
Okay, all right. All right. So hello, Mr. Guy Willner. It's such a pleasure, an absolute pleasure to finally meet you. I've seen so much of what you've done. You're very, very famous in the your experience again is legendary in the African data center space. So let's just start with a bit of introduction, given you're a very accomplished digital infrastructure person. So please, can you introduce yourself?
Yeah, so Guy Willner, I've been in doing data center stuff since 1998, when I sort of founded my first data center company and done stuff around the world from Western Europe through to Russia with the World Bank, through to South Africa with Terraco, and then more recently Kenya with IX Africa. And I advise Helios investment partners who are a big investment fund across Africa, of course.
Okay, we're going to come into a bit of those specific roles. You have tried to compress everything into that line, but there are some nuances we want to tease out based on the experience you've had. So yeah, we know that one of your companies, IX Europe, that you started and then you now sold it to Equinix, possibly one of the largest data center operators today. Can you share some context how it was then first starting a data center services company, then and then selling it, and all the processes that you had to go through?
Oh gosh, that was a long time ago. Um, it's actually the 25th anniversary this year of the creation of IX Europe, so that's quite fun.
Mhm.
But yeah, it was a mad time, I think. If I look at myself when I started it, I probably think, who is this idiot? He's because I was 35 when I started it. So if I looked at myself as a 35-year-old, I'd say this guy doesn't know anything. This is not going to work. Um, but yeah, I started it when I was 35 and with a friend of mine, Christophe Debouchet. And the key to the early success was matching my sort of mad dog enthusiasm, sales, business development, technology with a business partner who was finance, operations, structure, and process. And so the two of us worked very, very well together for 9 years during that sort of journey of IX Europe. It was a slightly crazy time because it was just dot-com bubble period, and we managed to raise a bucket load of money on a first round, another bigger bucket load of money on the second round, and then we tried to float the business and failed because the stock markets were all falling apart. But we'd done a roadshow with what was a fairly embryonic business at the time. We had two data centers under construction, a little one with the first customers. We survived. We had two survival rounds, and then coming through that, because we survived, we could then start picking up distressed asset, bankrupt data centers around Europe. So we did a bit of that, and then we floated again on London Stock Exchange on AIM. But we've been through a lot because we've been through the dot-com bubble, and 75% of our competition had gone bankrupt. So it was a tough time to survive. We made it through because we were really, really focused on keeping the cost down, taking no risks. And amazingly, we were growing 30% a year right the way through. Never had less than 30% in growth. So yeah, made it through, but we were a bit tired at the end of all that because that's a bit of a struggle. So we were sort of quite happy to sell out to Equinix and move on. And there's choices you make in life. I could have stayed on with Equinix, might have been fun. As an entrepreneur, I kind of like shooting from the hip, so that doesn't really work with a large company.
Mhm.
So I decided to sort of part company after 6 months, and then I was asked by Tim Parsonson, the founder of Terraco, to join the board and invest in that one. So I joined Terraco, and then that was exactly the same thing, early stage. Frightened shareholders because we hadn't signed any customers. Then suddenly we signed big customers, and all was well. And then it got sold, and then did another one in Russia with the World Bank, which was a good thing to do at the time because I was sort of helping communication and democracy, and now it's not such a good thing. And then, you know, that's another story. There's a, you know, I'm not involved in that one anymore. And then Kenya happened. You know, which was something that we were looking at Terraco, and then we decided not to look at it because Terraco was about to be sold. And I sort of came back to the Kenya project a few years later and thought, let's just do it. But that's not
Okay.
the answer to your question. You asked me about Alex Europe. I've been rambling.
No. So it's we have done given a bigger, more comprehensive context. And this will lead me to a follow-on question from what you just said. So you have been there, done that, and you have the shirts. You have started literally the way other data center operators have now started doing after that. They build first, or even before they build, they get customers. And then you mentioned how your board members already, your shareholders were already worried that you hadn't gotten any revenue, but eventually you're able to get. Would you do all that? I'm sure that must have been very stressful and very challenging, very filled with a lot of anxiety. Would you do all that again, given the insight that you have of 25 plus years? Would you do it all over again?
I think the problem is that we're made the way we're made. You know, we're cabled up the way we're cabled up, and I can't stop myself getting excited about a new project. So, you know, I have to force myself not to do too many things because I'm always doing something new or whatever. But it is the buzz, you know. It's, you know, ask the Rolling Stones why they're still touring. You know, they don't need to. They got pots of money. But it's the thrill for them of being on stage, and the thrill of playing music that they love, and the thrill of working with people they've worked with for years and years. And I think that's the same with me. It's the thrill of building a new company yet again, using the same recipe with, you know, involving people I've worked with in the past and know and love, and also bringing new people in who are new to the industry who come in. So again, Rolling Stones, you know, sort of parallel, bringing a young new musician on stage and sort of handing them the baton and stuff like that. So
Mhm.
there's a lot of enjoyment in doing this again. Obviously, you've got to be careful because, you know, there's an amount of exhaustion after a while if you're not careful. But I do love it. Yeah, I'm not quite sure if I'm going to do any more pure startups.
Mhm. Okay. Okay. Thank you. Yeah. So now to come a bit into some of the companies you have worked and some of the ones you mentioned. So we're going to look at how you raised venture capital in a lot of your roles. First at Compagnie General, now the Vendi Group, where you had about $210 million EBRD funding. And then at IETS Europe, where you raised about $100 million before you eventually sold it for about $555 million. You seem to have had, I don't know whether you've had patient shareholders or you have something you put on your tongue that makes them open their wallets. But what exactly did you say or do that made these corporations give you that amount of money when
I think,
yeah.
I mean, the Vivendi one, I wasn't involved in the money raising in that. I was an engineer. I was designing network and sort of doing network planning and helping with the dossier, but I wasn't involved in the fundraising. But it was an interesting experience to understand how that developed over time and how that money came in and what the project was, which was, you know, it was to build 160,000 telephone lines in a part of Hungary. Whereas the IX Europe and Terraco and Accelerate and IX Africa, they've all been going out there and trying to persuade somebody that this is a good idea. It's obviously easier to persuade somebody once you've done it a couple of times before, but surprisingly not that easy, not that easy at all. And I think one of the complications is as an entrepreneur, money is never the main focus. It's not about making loads of money. If I want to make loads of money, I'll become a banker or a lawyer. Entrepreneurs can lose a lot of money. It can be very, very hard. And so it's more about just trying to get the project done. And sometimes that means you don't really understand how the financial counterparty sees your business. You might, for example, just a case in point, private equity has a window of maybe 6 years. So they invest, they want to see some really good results in the first 2-3 years, and then they're looking at an exit for the next 3 years. Now, that's a very short period of time, considering the average data center project, more like 10 years. So, data center projects like, I mean, EQT's exiting, can't remember what they're called now, a Nordic data center business, and they've been in there since 2016. So that's normal sort of lifespan for a business. Whereas often a private equity fund would want to be out within the
3 years,
5 years of investing, 4 years of investing, and that's hard because data centers don't really fit that model. So I guess if I understood a bit more about where the funds were coming from, why they're investing, what their motives were, it would have been easier for me. Whereas I was just saying, but doesn't this look fantastic? Why do you want to invest? Sort of thing. So I think understanding the other side of the table is always important.
Okay. So what learnings? I'm sure now you've had significant learnings that you have now had from this experience, knowing the type of investors most suited for digital infrastructure businesses, which is more of a longer play. So what learnings would you pass on to younger operators who are trying to do some of the same things you have done, especially in Africa, where FDI funding has sort of slowed, as you rightly mentioned earlier? What do they do? What do they say? What learnings can you pass on to younger operators who are also trying to build digital infrastructure in Africa and again other emerging economies?
I think the first thing is you got to be convinced that your model is going to become profitable or has an exit route. I remember when I was talking about my first startup, and one of the first questions an investor asked me is, "What's your exit?" And I was thinking, well, that's insulting. I'm just starting a company up. Why would I want to sell it? And it really shook me up. But that's obviously, if you're building a company and there's no potential buyer and there's no potential route to exit, then who would want to invest in that business? So I think understand the value of what you're creating. Are a lot of people interested in what you're doing? Understand the profitability and and it doesn't have to be profitable short term, but understand where the profitability is going to sit when it gets there. Being very careful about building teams up without overstretching. Definitely punching above your weight. So if you're looking at, for example, setting up a board or an advisory board or something like that, and you're starting up a business, go for people who you think they would never accept because they're far too important or far too senior or far too experienced. Start with them, because if you luck in and get somebody who is very senior, not from the political world, but from the business world, if you get somebody very senior from the business world on your advisory board, that really helps enormously because you then harness all their experience and their maturity. So that's a good thing. And I think the last thing is don't listen too much to your investors. If you're building out a dark fiber business in, I don't know, in RDC or Nigeria or something like that, you're probably doing it because you know the market very well, because you've been operating in the market for years and years, because you've had this idea of a business plan for years. You kind of know who the people are. You kind of know who the customers are. You know the margins. You know the profitability. So if your investor comes in and they've been to some conference on the weekend which says something the opposite, just remember they're investors. They're very, very good with money, but they're not very good with strategy or businesses. So
operations, yeah.
One of the things you've got to be careful of is sort of, stand up on your own 2 feet and believe your model, believe your plan.
Okay, I'll ask you a question about culture. After it's one of the things that just came out of what you said, so then I'll bring that up. So now one of your current roles is managing director for digital infrastructure at the Helios Investment Partners.
Yeah,
And I believe you're responsible for all digital infrastructure funding for Africa.
allegedly,
So,
yeah.
okay. So what do you typically look out for before you cut that check? And
Um,
what do you see? What potential funding opportunities do you see across Africa within the next 5 to say 10 years?
I think first of all, the challenge of the bigger funds like Helios is that you can't invest in 20 different companies because for a big fund these days, for a big international fund these days, whether you invest in a $20 million company or a $1 billion company, the work involved, the legal, the compliance, the financial, the audits and all that, and the research and stuff like that is much the same. And when you've got 20 companies in your portfolio, you've got to sit on the board of 20 companies and try and remember which one you're at and whatever. So it's obviously much easier to sit on one board and invest in one company. That's always been the challenge in Africa in general, certainly in sub-Saharan Africa, because for the past 20, 30 years, sub-Saharan Africa has been starved of that small capital. The guy who needs a $500,000, the guy who needs $1 million, the guy who needs 2 million.
Mm-hmm.
And as a result, there's not a lot to roll up because there wasn't that startup capital available. And today there are a lot of funds with big chunks of money and they want to deploy big chunks. And we're one of them. We want to deploy 50, 100, maybe 200 million into one project. So we're not going to look too much at smaller ones. And we're going to do a deal a year, maybe 2 deals a year, something like that. Not an enormous amount. In the life of a fund, we might do 6 deals or something like that. Typically, a private equity fund, for every deal it does, it's probably looked at another 49, which can be very exhausting in a PE fund if you keep running around, reviewing companies. Whereas an entrepreneur, I would invest in 1 in 2 because the others I just wouldn't look at if it didn't pass the sort of guest test and doesn't feel right. Don't want to do that one. But so what are we looking at? We're looking at carve outs from existing companies where they've got assets that they maybe non-core and they want to sell them off. That's always very interesting. Complicated stuff. I mean, Helios is a bit like Goldman Sachs special situations. They can cut a deal in different ways. When a company's got a difficult structure or different shareholding structure or whatever, then Helios can come out with inventive and sort of creative ways to deal with all of those things to find a way forward where everybody is happy, and that's a real skill. And obviously in the digital infrastructure sector, then anything from data centers to towers to fiber, to even satellite or something like that, we'll see. I mean, obviously my comfort zone is data centers. I know that it's a lovely business. It's got lovely recurring revenues, and so that's my favorite.
Okay. So based on that, you don't really invest in, say, connectivity. I know you mentioned satellites, but say connectivity, fiber.
Yeah. I'm looking at it. I mean,
Do a bit of that. Okay.
I mean, there's Helios is an investor in Wananchi in Kenya, and it's got a bunch of a lot of fintech businesses on the finance side, and so we're interested in the connectivity side. It's just I've got to work out where the profitability is in that market, where we can add value.
Okay. All right. So still on what you do at Helios and now on some of the investments to investment options that you usually have. And there are many. You have cell towers, you have data centers, you have fiber networks. So that is on one context, what you do, the multiple platforms that you invest in. And then on the other context, we have a very serious digital infrastructure gap in Africa. population, however you dice it, whether from a connectivity perspective where broadband levels are less than 35%, and that is mobile broadband.
Yeah.
And when you do a deep dive into fit, it's probably less than 5%. So that's on one layer. And then you have a lot of digital divide, rural, urban,
Yep.
gender divides, male, female. So that's on one.
Yep.
Even in data centers where we have limited data centers. So for a continent such as our size, 1.4 billion-ish, whoever you ask, it's expected that we should have a bit more data centers. Some forecasts say maybe 700, 800 data centers or so on. So we obviously have a gap there.
I think currently Africa as a continent's got only 1% of the global data center park at the moment, which is absolutely nuts when you consider both the population and also, more importantly, the demographics.
So looking at all that, looking at obviously we have a low data center footprint to population. And there are many things that could be responsible for that. So what are the bottlenecks that you have seen across? Some of them I've mentioned, some of them you can also talk to. And how is Helios Partners as an investment vehicle into Africa? How is it planning to deepen that digital penetration on the continent?
Well, first of all, I'd say any communications or telecoms minister in any country can become a hero of the economy by deregulating telecoms, by fully deregulating telecoms. And we've seen that happening in Kenya, Nigeria, and South Africa. And we've seen it's just the whole tech planet in those countries has just exploded. And you've got startups and you've got investment funds and you've got tech companies and cloud companies and whatever. And it really had a significant effect on the economies in those countries. The countries that don't have any telecoms deregulation, where there's only maybe 1, 2, or 3 network operators, it's really very small. And sadly, ironically, very dependent on stuff abroad. So very, very little happening in the country, which means that any cloud that happens is probably offshore cloud rather than onshore cloud. Not much happening in the technology scene, which means that your super smart software engineers, techies, or whatever, they leave the country. So this whole telecoms deregulation thing is just a massive break on economic development. So number one is, deregulate telecoms, and that really would change things massively. Beyond that, the whole digital economy sort of it's a big construct that no single part is responsible. So obviously we need a lot more data centers, but we also need a lot more fiber, and we need more undersea cable, and we need more satellite access. Satellite's good for connecting the unconnected. It's easy
rural
to say,
areas.
yeah, it's easy to say, let's build some dark fiber, across Algeria or something like that. But I mean, you look at the distances; they're just enormous. It's not something you can do. It's not the same as a very densely populated area like Singapore,
Capital city.
Central
Yeah.
Europe or whatever. So there are different paradigms here. So each technology plays its part, but certainly data centers are a massive part. Inland, non-coastal countries need a lot more fiber, need a lot more really cheap access to the coastal undersea cables, and also need lots of data centers. But a data center thrives on being a marketplace for distributing content in a country. And a good marketplace has lots of people bringing content to the market and lots of distributors distributing content. And so you need that, you need 10, 15 network operators sort of duking it out, offering slightly different things to carry that content to the end user. If there's not enough network operators, then there's no real market, and then it's just very quiet.
Okay, thank you very much for that, guy. Yes, so
And
you operate.
sorry, go ahead.
No, go on. You go on, please.
We've seen that, the growth of regions, compute regions for the big cloud players. We've got in 1 week alone, just in this week, we've heard,
Oracle,
yeah,
Google.
yeah,
Yeah,
exactly. Google
yeah,
announcing South Africa is now live as a region,
yeah.
and that's a region just like there's a region in the UK, or
Mm-hmm,
four of them in the US or whatever. And then
mm-hmm.
Oracle coming out, and it wasn't,
In Kenya.
first the government announced Oracle's coming, and then Oracle announced that Oracle's coming. So this is a real official message that
Mhm,
Oracle's building their region in Kenya now. So we know it's inevitable that there will be a significant number of regions. Say there'll be 4 or 5 different cloud providers in South Africa, Nigeria, and Kenya in the next 5 years. We know that's just inevitable.
mhm.
Um, what we don't know is what's going to happen next in other countries, and how that is going to feed into the ecosystem of other countries nearby.
Okay, thank you. That's a question I'm soon going to ask about the data centers and footprint and everything. But let me quickly ask this one. So you operate across multiple markets, right? And you have, I'm sure you sit back and you can look at the market and you have a dashboard that says, okay, this is why this market is best, and this is why I prefer this. What are you currently seeing comprehensively across all the markets that you operate? That's one. And then individual markets, what growth opportunities do you see? And then many have said that Africa is at this inflection point. Do you agree or not?
Yeah. So I mean, what are we seeing across the markets? The markets are, getting sophisticated, and demand for compute is getting bigger and bigger. And it's more and more difficult to operate as a bank in a country if you can't sit on some really sophisticated financial cloud, with all of its protections and cybersecurity and everything else like that. So, every single bank across Africa is going to have to be super, super technical, and
Mhm.
and based on a number of cloud providers over the next 5 years. So that's a big draw for the internet and for infrastructure. Governments are also looking at how they can digitize all of their economies. It's very interesting for them. We can track things better. We can track the economy, track the money flow, etc. So there's a lot of that, and there's a lot of push, obviously, from countries outside, from China, from the US, from Europe, to help digitize, and those, that money's being put into digitizing government across Africa. Um, and then on the user side, as you get more and more sophisticated phones in your hand, and even the cheapest tablet phone can do, equivalent of a supercomputer 10 years ago. The demand for more digital services from the market, from people, is increasing. So yeah, there's a market pull, and there's also a sort of a slight push.
Okay, all right. Okay. So I want to ask you about data centers now. We've talked about this new cloud operators coming in, Google, in South Africa, uh, Oracle in Kenya, and they are not the first.
No.
AWS has come in already.
Yeah.
Microsoft came in much earlier. So there are a bunch of cloud providers um, in Africa. And then we now have to look at the data center footprint. So in terms of wattage, I'm not sure all the data centers, for instance, in Nigeria, I don't think that all of them are up to 100 megawatts, and that would be very far off. Maybe 50, maybe it's closer to
Yeah, I
50
probably 50 in terms of built,
in
even
terms of
that,
built.
in terms of
Yes,
really
in terms
built,
of build capacity.
maybe not even 50, maybe like 30 actually built
Uh,
out a region.
uh-huh. Yes. So, and then maybe if we look across Africa, maybe so there are pockets, maybe South Africa maybe has the most.
Yeah.
But even all that, I don't think maybe we have up to 200 built.
No, I don't think so. I think South Africa could be anything between 100 and 180. It's
Okay.
probably north of 100 in terms of built. I mean, it's very difficult. Like, we have a campus in Nairobi. The design is 22.5 megawatts. We've actually commissioned two and a half, and then
Okay.
we'll bring another 2.5 live, so we'll be at 5 at the end of this year. So that will be 5 live from us.
Okay. Okay, so it just shows that on the continent we're not doing as much. So let's say we're 250 megawatts, but
Yeah,
you hear one data center in North America is one data center is 100 megawatts.
yeah.
And it's surprising to me that what's happening there? What's happening there? Is it that the demand isn't as much here? What are the drivers, really? What are the true drivers of data center growth?
I mean,
And why are we not seeing as much here in Africa?
I mean, Europe is 5 years behind America on a lot of this stuff already. When cloud started happening, what, 10 years ago or whenever it was, 15 years ago, most of the big US companies just embraced it and said, right, okay, guys, we're all going cloud, we're going to do this, and it's the American way. It's kind of, we'll try it out and we'll fail probably, but we'll learn as we go and then, it'll carry on. Whereas Europe tends to intellectualize and not want to trust outsiders as well. So often, I mean, in the early 2000s, I was trying to sell data center to BMW, and a German friend of mine said, "Forget it. BMW makes their own desktop computers for their staff.
Hmm.
There's no way they'll outsource anything."
Hmm.
Of course, they did. 15 years later, they're sitting on the cloud like everybody else. But this this
Mhm.
this whole outsourcing thing is an issue. So the Americans tend to embrace stuff much quicker than anybody else. So
Then
AI,
Europe.
case in point, Americans, all big companies are throwing quite a lot of R&D development
Mhm.
budget into working out what AI is for them, what it can do for them.
Mhm. Mhm.
Whereas in Europe, they're probably not doing nearly as much of that, and that hasn't flowed um, into Africa yet. However, it's not linear in the sense that Africa often leapfrogs, and we've seen
Mhm.
that in the past. But
Mhm.
case in point, there was an Eastern European data center business I was looking at. It was 20 years old.
Mhm.
It had 2 megawatts of capacity
Mhm.
and a lot of customers, and the great and the good. Amazing big
Mhm.
names, but big names with a little
Mhm.
installation in their data centers, like
Mhm.
150 customers. And
Mhm.
50 of those logos you would know. They're just known by everybody.
Mhm.
Took them
Mhm.
20 years to get to 2 megawatts. And we were
Mhm.
saying to them, okay, what we're going to do is buy your business, but we want you to build a 20 megawatt data center down the road because we've got 3 clients who each need 6 megawatts.
Mhm.
And they looked at us as if we were mad, because they spent 20 years building this up. And then suddenly we said, yeah, but fine, that's interesting. But actually, in 18 months, I want you to multiply it by 10.
Almost 10x.
Yeah. So this is going to happen across Africa as well.
Mhm.
And yes, Microsoft and Google and Amazon are present in Kenya, but they're present got a tiny little presence at the moment. They're not regions. A region is a big, big investment, and that's a real compute thing, and it's quite complex because you have to offer the whole suite of services, and that's a very big thing. So it's likely that we'll see this same thing happening, and then on top of that, there's the whole green energy thing.
Mhm.
If you look at Brazil and Norway, for example, they're both getting, and to a certain extent, Chile in Western South America, they're getting some really big data centers because there's lots of green energy.
Mhm.
Kenya has abundant green energy from geothermal from the Rift Valley. So you basically dig down a little bit, you get steam out, you put the steam into a turbine, and at the other end, it's generating electricity, and it's relatively
Mhm.
simple. You don't have to dig very far down. Um, and there's about 5 gigawatts of that available probably for the next 4 million years. So that's pretty stable. Because it's so much green energy in Kenya, there is a possibility that over the next 10 years, Kenya becomes a real hub for compute, connecting through undersea cables down to South Africa, up into the Middle East, and over across to Western India, where this free energy, this green energy, is not available.
Mhm. Mhm. Okay. So, but maybe that would lead me to my question, to another question. Maybe now you've talked about how alternative energy is attracting some data center providers. I would argue that West Africa, Nigeria has quite a lot of sun.
Yep.
So how can we potentially convert And I don't know if that has been done. Obviously, they say, okay, the huge process computing. I don't know whether solar can do it. But again, we have alternate energy. So what do you see there? Do you think that can be attractive to make countries like Nigeria?
I think so. I
Um,
mean, I think Nigeria will always be, Kenya has what's Kenya got going for it. Kenya's a relatively easy place to do business.
mhm,
Um, it's got a well-educated population and it's got green energy.
mhm,
Uh, Nigeria has a massive population. It's relatively wealthy, and there's a whole load of oil industries and other industries in that country. So it's more attractive in terms of for the cloud providers because there's a lot more business out there, but the energy is not so green. The cloud providers are not so worried about the green at the moment. They're coming round to that, but
mhm,
a lot of the approaches to green energy currently are sort of building a 50 megawatt data center and then building a 100-hectare solar field somewhere, maybe 300 kilometers away, um, which satisfies the green energy requirement, but it might not be direct. So
mm,
the data center may run off gas,
mhm,
but the data center company has financed the creation of a solar panel field,
mhm,
which is generating the equivalent amount of electricity, but green energy.
mm,
So
Okay, that's
So
an
either,
interesting
yeah, so either it's a
model.
direct connection where you've actually directly connected to the data center some green energy, or it's the data center company in its investment in the country
Mhm,
subsidizing the growth of green energy. And both
mm,
are good. Both are good.
mm, mm. Okay, that's interesting. So, in your different roles, both as a managing director for Helios, the infrastructure parts, and also in your role as chairman of IX Africa, and the multiple roles that you have, what do you see for emerging countries like Nigeria? I know your IX Africa plays a lot in East Africa and so on, but what other countries are you exploring at the moment? Where do you see good opportunities, and what's the plan?
I mean, it is Kenya, South Africa, Nigeria. That's the easy ones. If I could do something there, I mean, there's a lot happening in Nigeria, so that's
Mhm,
good. There's a lot of players coming in. There's a lot of build going on. But the thing about Nigeria is you could have 10 times that build and that would be fine. It's just a case of creating that critical mass and getting things moving, and then all of this starts really happening. So I can see a lot happening in Nigeria
mhm,
over the next 5 years.
mhm. Okay. All right. So we're gonna go into new technologies, AI, IoT, and so on. And one of your questions, actually, one of the questions you answered, what we talked about, what we looked at, data centers, the trend in data centers globally in North America and co. And then when you compare them to other countries, other climes that sort of catch up. The AI bug has naturally is sweeping the world, and it has naturally beat North America ahead of everybody. And data operators now have really caught it. Just a couple of weeks ago, we spoke to Raul Martinek. He's
Oh
the
yeah, yeah,
CEO. Yes, yes. He's the CEO of Data Bank.
yeah, yeah.
And then Data Bank is the
It's a very big
largest,
deal.
yes, they're quite big. They're the largest data center operator in North America. They have over 65 data centers and so on.
Yeah,
Um, and we spoke to him about his AI in digital center investments. He's doing a really big AI play. He believes that's the future and he's going all in. He just raised $533 million
yeah.
to scale up data centers again. So for you, now that since you operate in Africa, and then obviously you also look at investments in other markets, do you have any AI data centers planned? And then on that scale,
No,
um,
we're ready for
yeah,
we're ready for it, but the
okay.
mistake that has been made both in Europe and Africa and other markets over the years is to see what's going on in America and try and sort of copy that. And it's all about timing, and data centers use enormous amounts of capital. So if you build your data center and it sits empty for 3 years, you may have lost 40% of its value after 3 years because interest rates are pretty high.
Yeah.
So you really don't want to do that. You know, I've always drew the parallel. You know, if you're paying 12% interest, then if your door handle costs you $100, then it's costing you $12 a year to have that door handle on the door. If that door handle's not been used for 3 years, you know, that's $36 you've
That's
lost out of
$36.
Now, if you're in Switzerland and you're paying 0.02% interest, doesn't matter if that door handle sits unused for 10 years. You might as well build a whole data center out because it's not costing you anything. And up till recently in the US, that was the case. You could build a 100 megawatt data center because at 2% interest, it didn't really matter if it sat empty for a year or 2 or 3. You fill it. Whereas that can kill a project in a high interest rate environment. And higher interest rates have made people a bit more sensible over the past few years. So that's a good thing. So no, we are AI ready in the sense that the way we've designed our data center is we can cope with 50 kilowatt racks with no problem at all, which is massive for the market. You know, the average is going to be about 12. You know, in a more classical data center, once you're getting north of 12 kilowatts, it's getting very tricky. But we can handle 50 because it's a brand new data center. You know, so designed it that way. It doesn't have a raised floor. It's on a slab. It's got cool wall technology. We've got adiabatic. We've got all sorts of interesting technologies. And we've got loads of space and fantastic ceiling height, so we can kind of soup it up and modify it over the years as we need to. So, you know, if for example, if we need direct-to-chip cooling, we can do all of that. There's no problem at all. But I'm not going to invest in all of that up front. But I'm going to make sure that all of the guts of the data center are adaptable and ready to do all of that.
Okay, that's an interesting argument against AI data centers right now in Africa.
Well, it's the same. I mean, a lot of, you know, in the past, you know, people would say, oh, I'm going to design a high power concentration data center, so I can put all these high power concentration racks of, you know, supercompute into the data center. And I say that's interesting, but you know, if you get Standard Bank coming in and they want 20 racks, maybe 2 of those racks are high power, and maybe 5 of them have practically nothing in them. Maybe they've got some instruction books stacked up in a little box at the bottom of the rack, and it's not using anything. So if you design your data center and build it, assuming that every single rack is high power, you've spent maybe twice as much capital as you need to, and you'll never get a return because you'll basically spend 200 million on a data center, and 10 years later you'll sell it for 80 million. So you have to be
And
really
then
careful about this. Sort of listen to the customers, understand what they're doing. You know, I was talking to a hyperscaler the other day, and they said, okay, we're nudging towards about 22.5 kilowatts a rack. But that's kind of max, and we'll share, you know, our build sheets and everything with you. Yes, 70 kilowatts a rack is coming, but it's not coming yet. It might be in 5 years. You know, we'll give you warning.
Okay.
But in the US, it may well happen. I mean, Raoul's smart. You know, he's gonna be building for, and as I said earlier, you know, this is the wave that JP Morgan's gonna say we're going AI guys, and they'll spend, you know, 500 million on accessing a whole bunch of AI compute for JP Morgan. So, but Europeans and Africa is not the same. We're, you know, we're more conservative.
Oh yeah, he actually also spent some time explaining that, because I asked him the same question around why North America, why are they doubling down on North America and not emerging markets? And what he said is that he can look at a dollar, how much the dollar give him in North America, in the market where he's more familiar with, in the market that has proven potential, than the same $1 in an emerging market where there are different institutional voids he has to overcome. And then he's not sure about that $1 at the end of the day. So naturally, he just prefers to go into markets that are a bit more predictable for him. And I get that. Okay. So you are one of the leading lights in Africa's digital transformation journey. IX IEDS Africa, and also your roles, your multiple roles as chairman of IEDS Africa, as a managing director of Helios Partners, and focus on infrastructure. If you had a silver bullet to solve our digital transformation challenges, what do you think? What would be that silver bullet that you'd say, okay, let's do this and let's double down on this. This is the only thing we do for the next decade. What would that be for you?
In terms of Helios or in terms of the market?
In terms of the market.
Now, I'd probably say telecoms should completely deregulate, and with no government having overall control of any telecoms provider. They can have shareholdings and that's no problem at all, but not having overall control. And I think then that would create a crazy mad environment where people are building networks everywhere. And it's happening in some countries like Kenya and South Africa and Nigeria, but it needs to happen right the way across Africa. I think that would be a big one, I think.
Okay. So almost last question. So and I just wanted to just see your perspective on the industry at large. So Africa has a proliferation of subsea cables, right? They're quite a lot. So now we had Equano and to Africa coming last year, within a year. Equano had 144 Tbps, to Africa has 180, 190, 180 Tbps. And then they are meeting a lot of existing subsea cables, main one, below one, Watts, ACE, all of them. So there's a lot of capacity coming into the continent, but staying on the shores.
Yeah.
But the problem is the capacity isn't really leaving the shores, because the last mile and middle mile infrastructure that will take it to my house or my office and the public institution hasn't really been built. And then you now have the context of the data centers that we have. Data center population is quite low. What do you think we can do as operators, as regulators, to ensure that we develop? Because a lot of focus seems to be more on the subsea capacity side. What's your take first on that? What's your take
you're
first?
right. I mean, it's the landlocked countries that are suffering because it's fine, it lands on the coast and there's a cable landing station and then there's some fiber goes inland, but it's not going inland far enough. And by the time it gets to the landlocked country, it's quite expensive. The bandwidth is quite expensive. Not quite sure. I mean, I'm sure governments could help in terms of tax incentives, both for data centers and for dark fiber builds. And if there could be some sort of encouragement for dark fiber companies to not pay taxes for 10 years or whatever, or have no import taxes or whatever, I think that could really help. And the same for data centers. If data centers could have that encouragement, I think that would encourage people to invest. But obviously, it all goes along with the market, so that even with all those incentives, the market has to demand this service. And so we need startups in those countries. We need technology companies and new systems integrators that are successful, and that is happening. So it's you can't make this go any faster than it will. I think the only there are disruptors to this. One is saying, okay, I'm fed up. The fiber's just still not coming to my town. I'm just going to smuggle in a Starlink and whack it on the roof, and I got 20 megabits per second, and that's fine. I got one in France because it's exactly what I did. I got a house in the mountains. The local municipality trumpeted the fact that fiber was coming to the valley. 2 years later, still no internet. And I said, what's that?
Yeah, fiber.
Because we got the fiber, but the subcontractor that's going to put the equipment in, and we haven't chosen them yet. So I was like, okay, forget it. Okay, I'm going to get myself a Starlink. So I got myself a Starlink. It's great. It's 40 euros a month, which is not too expensive. So imagine if I'm in, I don't know, Pretoria, and I'm in a small block with maybe 12 apartments. I could, in theory, whack a Starlink on the roof. I'm paying 40 euros a month. Divide that by 12. That's not very expensive, and it's pretty good bandwidth.
Mhm.
So that's potentially a disruptor, and that's why we're seeing that the countries are trying to regulate that, because obviously it's also disrupting in the sense that where does that traffic go? How do
Mm.
you deal with data sovereignty if
Mm.
somebody's got a satellite link where the downlink could be in
Yeah.
Morocco, you know?
Yeah. Mm. Mm.
So that's
Okay.
going to be a challenge for regulators.
Mm. Mm. Okay. Okay. So this is while I saw one of your quotes where you said and I thought it was very interesting. You said that foreign aid is often a driver of corruption. Can you share contexts about what you meant by that?
I just think, I think the best thing in any economy is to do business and create more business people, because business is apolitical. A
Mhm.
business works or it doesn't work, and it stacks up. It's more, I'm an engineer, so I like that sort of thing because it either works or it doesn't work. Um, and if there's sort of aid money coming in, it can mess up the environment, in the sense that you're trying to build a business and trying to run it sensibly to make a profit, but then somebody down the road has just been given a whole pile of free money so that they can compete with you and charge half the price. So the net is that you go bankrupt and they become a monopoly, but they have no idea of business because they've just been given a bunch of free money. So nobody's learnt anything, and nothing's moved forward. Obviously,
Mm.
the difficulty is if there's no aid money and there's no business investment, then you really got a problem. So
Mhm.
I would prefer a lot more IFC type, World Bank type investment in businesses.
Mhm.
I had IFC invest in one of my business, in two of my businesses, and I can say that they are very strict and they're very tough,
Mhm.
and they're very tough businessmen. It's not free money.
Mm.
It's money you get when banks might not give you money,
Mhm.
but it's still, the conditions are the same. The shareholding agreements are still so strict. Everything's very, very strict. That I like. And what would
Mm.
be nice is to see that kind of IFC type money going in to many different countries across the African
Mm.
continent, but at a much
Mm.
lower level, from like $100,000 upwards,
Mm.
because that seeding businesses just creates a massive community of entrepreneurs, and that just, the whole thing mushrooms.
Okay, thank you. So very last question, and I said I was going to come back to that question about culture.
Yeah.
Um, yeah, so one of the things you said then is companies have to be careful who they're starting off with, the sort of company, sort of people they have. Can you share some context on that in terms of, so I'm an entrepreneur, I'm starting this data infrastructure company, I'm starting this. What do I look out? What types of people do I hire? What do I look out for them? And even when I'm also creating my leadership team, when I'm speaking to my board, what sort of leadership team do I look out for? What sort of board do I want to help me move this company forward?
I mean, my co-founder Christoph, years ago, he was asked by one of the investors, "What's your biggest challenge?" And he said, "Culture." Um, because if you get it wrong in a company, then obviously the company culture can become toxic, it's just not a nice place to be, and therefore it just doesn't function properly. So if you can get the culture right early on, it's a multiplying factor. And that's all about trying to get people empowered, trying to get people involved, trying to keep the organization as flat as you can, um, so that people are not afraid of coming up with ideas or saying, actually, I don't think that's a really bad idea or whatever. So you build up this whole team culture. Entrepreneurs sometimes can be guilty of assuming that everybody else is going to work 18 hours a day.
Mm.
And imagine if you're an entrepreneur and you started a business, and yeah, you might not be paying yourself very much, but if everything goes well, you might make $1 million out of this business. And there's somebody there in your office who's being paid $500 a month, and you're fed up because they're going home at 6 p.m. every day. But they can look at you and they can say, that's fine. You work hard, you're going to make $1 million. I work hard, I get paid $600 or $500. So what? You haven't even given me any equity. I haven't got any shares in the company. I've just got a salary. Why should I work like a mad person? So this is the problem with entrepreneurs. Sometimes they don't understand that people around them are not as motivated as them because they have not motivated them, because they haven't shared out
Mm,
that
mm,
or because the people around them are not motivated by the same thing. They might
mm,
really enjoy working in the company, but they don't enjoy staying until 9 or 10 p.m. every night. So
mm,
that culture is really important, is to get everybody to feel to contribute and to get the freedom to make comments and to contribute to the company and feel empowered. I think that's, and getting that teamwork going across right the way across the company, so don't start building silos. But it's a big challenge, you know, building a small tight management team of say 10 people in a company can take, it's like distilling a very good whiskey. You know, you might, to get to those 10 people, there might be quite a few people who come into the company and who leave. Normally, very, you know, 99% of the time, they just leave because they don't like startups or they don't like the fast moving environment or whatever. But those who stay, they kind of cross the line and they
mm,
take ownership of the company. And then, you know, I've had this a couple of times where suddenly you see this management team, you think, wow, that's amazing. Like the finance director really knows how to do finance, but he's not stepping on the toes of the marketing director who really knows marketing very well. And they mutually respect each other enormously. And the CEO's there making sure everybody's, you know, free to give their best. And if you can get a management team to that level, that's just amazing. Then it's bulletproof, because then instead of having one person running a company, you've got 10 people running a company. So
mm,
then if you have a big recession or a big political problem or whatever, it's okay. You can sail through that.
mm, mm. Okay. What about from a board investor perspective? How do you also get the right people?
So you can see from investors, you know, when you're trying to raise money, you can see what the culture is of the investor. You know, if they're overly aggressive and overly focused on a very quick return, and they don't ask you many questions about the management or the business or what you think about, you know, where things are going or whatever, then you kind of think, okay, this is just a transaction. There's no emotion in this. There's no connection. The reason why you need a connection with your investor is for when things go bad,
Mm,
and things often go bad. You know, something like 99% of startups close down after 5 years. You know, so
mm,
things go bad. Um, and so if your investor is somebody with whom you've built a relationship over time, a relationship of trust and respect, then if you do get into trouble, then you don't get sort of destroyed by the investment fund, or they don't just walk away. They'll support you and build up. So it's very important that you feel supported by your investor, even in the early stage. In
mm,
terms of the board, you know, you're looking at people who are going to add value and help and mentor, but you're not looking for people who want to be a sort of part-time executive. You know, you don't want them to be running around telling people what to do. That's not their role. Their role is to mentor and help people mature.
mm,
And and to a certain extent, on your board, your independent directors are there to help balance out between the investor, what the investor wants, which is, you know, to build and sell as quickly as possible, and what you want, which is to build a really good business. And these independent directors can help sort of calm that down and be the diplomats of the company.
mm. Okay. Thank you very much, Guy. It's been an absolute pleasure speaking to you on this and that for the last almost more than an hour.
Goodness me,
Um,
I've been rattling on.
thank you so much. So I'm going to stop recording now.
Thank
Yes,
you.
and then we can, yes.